Good evening, ladies and gentlemen. Michael Silva here. You're watching the Stock Market Brief Show. I'm away traveling right now, and I wasn't planning on getting the market brief out tonight. So unfortunately, it's a little bit later than usual. But given the context of what happened today in the market, Jerome Powell came out, cut 25 basis points, gave some guidance, and the market really just did not like what it saw. So, and that's despite even me being on the big screen. You'd think that the market would love that. Nope, absolutely not. We just kind of sunk off into no man's land. But I want to talk about the rubber band effect. And no, this isn't a technical term, but given the context of what we saw, I think it's a good analogy to use for when we start to see more volatility in the markets. Right here, you see a rubber band and it's being stretched out, right? And what happens if you keep pulling and pulling? Well, it could potentially snap. But what happens if you let go? You can see snapbacks. And I think that that's what I got to kind of hone in to on today's market brief. So if I show you the chart of the S&P 500, this is obviously a wild day. It was down we're just going to round, 3% it was down. The last time we seen that was August, which coincidentally happened to be also when I was away traveling. I don't get it. Why does the market got to do this stuff? Okay, so when we see big days, if I zoom out and we're just looking at a one-day rate of change dating back to like 2000, and this is, like I said, one-day rate of change. So when it's above the zero line, that means it had a positive day. When it's below the zero line, it has a negative day. But what do you notice? This is what I mean by the rubber band effect. You'll notice very, very big up days and very big down days, they're surrounded by each other. So when you typically see massive volatility to the downside, you'll typically see big moves to the upside. Now, that doesn't mean we're going to rip to new highs by tomorrow or anything like that. But given the context of a rubber band, when you start stretching out, if you let go, right, things can obviously see some monster rallies, and this is where people tend to get tripped up quite a bit. So what do? Well, I look at market conditions. What do I look at? I talk about the gamma flip line here very frequently. In fact, if I look at a 5-minute chart of the S&P 500, you'll notice about 10 minutes after the announcement of the was this the, I can't recall because I didn't get to watch it live, but it was 10 minutes into the announcement of the rate cut, not the press conference, the rate cut. We had crossed through the gamma flip line, which was roughly at about 60-40. I'm give or take a little bit. Now, look what happens when we start getting under the gamma flip line, right? We talk about this frequently. What happens? Dealers, they start selling into selling or they buy into buying. So you get what? Increased volatility. What happened to the VIX? All right, you can pull up VIX or you can look at just VIX futures. And what happened right there at that time, right? 10 minutes in, bam. And then what happened, right? We saw a little bit of an uptick, but we really started shooting off to the sky. And if I show you, the times that we were in negative gamma territory, which is basically, this is a historic chart of it, you can see we were already pretty deep into negative gamma territory. We haven't seen this since August. When it's white up here, this is positive. We're above the flip line. When we're below it, that's below the flip line. And if I drew this out on the VIX, where you can see the gray shaded areas, you'll see when the gray shaded area appeared, that's when we crossed under the flip line. And then when we crossed back underneath it. And you'll notice during those times, it gave good insight to pops and volatility. And today, clearly as day, right, we're back into negative gamma territory. And when we look at the conditions of the market, the two that looked decent yesterday were Qs and semiconductors, but the SPY was giving us warning signs. We had the IWM giving us warning signs. It was below these averages on an intraday basis, biotech, if you trade biotech, and then also Dow Jones Industrial Average. They were all below their declining 5-day moving averages, which gives a little bit signs of caution. Okay, so that's all and great. Where is the flip line now? Well, as I updated it just at the end of business just a little while ago, it's about 59.20. So we're slightly, it's been updated. We're slightly still in negative gamma territory. You want to see these levels reclaimed, but traders are happy to reach out a little bit lower. The put wall in this current context, it may change in the morning when all the data is aggregated, but it says 5,700. So local support would be down here at around 5,800 if the selling continues. And then we have local resistance where kind of price is. So be paying attention to see if we can cross back into these positive gamma territory. But as it stands, when you stretch out like this, don't be shocked to see snapbacks at points, but just be aware that if we're still below these declining shorter term averages, and we're kind of around this gamma flip line, you can deal with a lot of whipsaws and a lot of chops. Now, me primarily, I'm a swing trader, right? So what do I do when the market conditions change? Well, I manage the positions that I have on. And then when I enter into new positions, I'm already aware that many breakout type of stocks when we're in negative gamma territory lead to more fake outs, shakeouts, and whipsaws. So I typically reduce my position sizing. Now, going into tomorrow's trading session, I'm just going to go ahead and share the daily expected moves that I typically share with my Discord group, but I'm going to share them here too. They are absolutely huge. So, I mean, this is typically the implied volatility you see in a week. The daily expected move for the S&P 500 is near $90. That's plus or minus. Okay, so this is some huge volatility, and you can really get, your head kind of lopped off in this if you're on the wrong side of trade. So just be aware. The SPY, I mean, like a $13 plus or minus expected move. I don't expect it to go this far, but holy moly, if it does, these are some wild moves. Just remember, think of the rubber band. Qs, $10. It's very rare, actually, that you see the SPY have a larger implied daily move than the Q. So that's interesting. And then Russell 2000, which got hit absolutely crushed today. We're looking at a $6 implied move. So let's update you on some of these indicators, some of these signal charts and breadth, which kind of lead me to believe that we can see some big snapbacks. With that said, though, understand that it doesn't mean that you push your limits on a snapback, right? Because you want things to calm down a little bit. You want to feel when things calm down a bit, it allows for a little bit better risk to reward. Now, I'm showing you back month versus front month volatility. Now, we've been above 20% here, right? Which tells us back month volatility is 20% higher than front month. And when it gets up into these levels, this is what we've been saying here, is you typically get consolidations or pullbacks, whatever the case may be, and you really want to get more interested in buying if we start crossing back under the 1. And sure enough, today, I mean, just look at it. We're back down here at 0.88, which is another level that's pretty rare to see. But this also happened right there in the bottom of August. But that came after 3 days of volatility, really to the downside. So in one single trading session, bam, we got smashed to the downside. It can remain down here. We can see moves like this, kind of like how we saw up here. But just be aware that the divergence here has changed substantially in a very short period of time. This is the put to call ratio. I like to apply a 10-day moving average to it. And this was another thing that we've been talking about. This one hasn't updated for tonight, but we've been talking about the last time we were down at these levels was, well, leading into August and, well, leading into, I guess, August of that year too. And when the put to call ratio started turning back up, it led from these lower levels to, 10% correction, a 6.5% correction. And now we're seeing ourselves correct a bit here from all-time highs as it stands. If you watch things from an intermarket standpoint, the dollar is really following the path of what it did in 2016 going into 2017 for the Trump election. As we stated in prior videos, we saw typically bearish seasonality for the dollar towards the end of the year. But if you look at in 2016, we saw a rip during the same period that the dollar fell, basically till December 5th. We saw a pullback in 2016, and then we saw it rally into 2017. And while we're coming to the year end, the dollar's rallying, breaking out. The 10-year yield made a very large move. And as we've stated, when you see these things go up, we have seen the market really struggle in various other assets. So look at the S&P 500 as these have been going up in recent trade. And you can look back through this chart and see the times that they've gone down. It's actually helped the S&P 500 to an extent as well. I'm just showing the S&P 500, but there's other assets that you can look at as well. Let's take a look at another way of looking at breadth. We shared this one yesterday, but look at the reading now. The percent of stocks above the 50-day moving average in the S&P 500 is 20%. So put another way, 80% of the stocks in the S&P 500, 80% are below their 50-day moving average. Now, does that, if you trade based off of the averages, good for you, do what works for you. I do end up caring about the direction of where that 50-day moving average is located. So I can't explain that on this chart, but what I can show you is we haven't actually had this low of a reading since 2023, more towards going into November, where we found, once again, another bottom. Now, on the flip side of that, if you look at the percent of stocks above their 200-day moving average in the SPX, it's not quite to that extent that we saw in November's during that correction, but it is the lowest that we've seen since around that December. So still a pretty low reading overall. The percent of stocks above the 20 day moving average we showed yesterday, and take a look. They're actually now moving into some pretty frothy territories to the downside. Look at 8% of the stocks. So, and once again, another way to put this is 92% of the stocks in the S&P 500 are below a 20-day moving average. And you could look at all these index products here. You have small caps, mid caps. You got the 1500, the 100, which is the largest market cap names in the S&P 500, Dow Jones, NASDAQ, NYSE. The NASDAQ composite over here is not really in too much oversold condition, but we're getting pretty frothy after today's price action to the downside. If you look at something like the NASDAQ McClellan Oscillator, you can see also reaching into territories where we found bounces from. We talked about that one yesterday, but for the NYSE McClellan Oscillator, it wasn't quite an oversold condition, but it was reaching to those levels. Well, today, that is one very, very extravagant reading that we haven't seen. I have to go back to the last time we've seen this, but definitely in the last year, 2 years here that I'm displaying, it's one of the lowest readings, and rightfully so. It was a wicked day to the downside. So that's the majority of, as far as signal charts go, breadth charts, a little bit of updates as we're kind of moving into this volatile environment and these expected moves. So I want to just post this chart here. This is the S&P 500, the SPY on the 15-minute time frame, and just give you an idea of just how volatile it is. So this was the weekly implied move, right? This is what the market was pricing in. Well, the market heard what the Fed had to say, did not like it, at least at this current moment. We'll see how it digests. You know, got to give the market time to digest the information. But we have basically broken to two standard territory of a weekly expected move. The monthly expected move, which we're still not month end, is right here. So we're not too far from what the market priced in for the month of December. Going into tomorrow's trading session, you can see that we're below a 5-day moving average. It's starting to decline now, and it will even if we start bouncing back up into these areas. We're below the week to date, and we're below the month to date anchored volume weighted average price here too as well. So what to expect? We have daily implied moves. If the rubber band wants to stretch out further, pay attention to these lower expected moves. That would be, I'll be quite honest, that would be a wild move if it reaches down there. And you know, it's hard to be surprised these days with things that we've seen. But if we start to snap back to the upside, if the rubber bands let go and some pressure's released, where can we potentially go to? Well, remember, the probabilities are always higher that we come back to the weekly expected move, the happy place. I would much prefer to be there, obviously, if we were back in, if we were still in positive gamma territory. But dynamic hedging kicks in when we start breaking from these levels. And you could really see that here and when we started crossing under that flip line. So if we do start to see that snapback, which I think is a possibility, remember, in negative gamma territory, selling begets selling, buying begets buying. So if we come in, I'd be looking for a potential move into and around this daily expected move and back to and around the weekly implied move. That's what I'd be looking for to the upside if you're more focused on day trading. As far as the swing trading aspect, my foot pretty much is coming off the gas until things start to settle down. Hope that helps out, gives you some insight into the charts. Sorry it was a little bit later than usual, but that's all I got for you. Hope it helped. See you later.